If you own a business and you financially support your family, then setting up a family management company could significantly reduce your taxes. I recently saved a client over $18,000 in federal taxes alone by setting this up at mycpacoach.com, and I want to fully explain this strategy to you in this episode. If you spend any amount of money on your kids, your spouse, your parents, your grandparents, grandkids, auntie, uncle, or any family member for that matter, then you may be able to benefit from this. You see, when you support your family without associating them with your business, you receive very little tax benefits for doing so, especially as your income grows. You do not get a charitable tax deduction or business write-off for simply spending money on your family. But if you instead hire them in your business, you can turn that financial support into a tax deduction that ends up lowering your taxes by several $1,000s. And some people who already do this may be surprised by some of the stuff in this video because there are some hidden taxes that you may end up paying depending on your business structure. And I'm going to show you how to get around that. For example, if you operate as an S Corp or C Corporation, you must pay payroll taxes on the amounts you pay to your family members, which can be very expensive. However, setting up a separate LLC, also known as a family management LLC, can help you get around those taxes, which I will fully explain in this episode. So please go ahead and do me a favor and smash that thumbs up button for me below, and let's jump right into this strategy. All right, so let's start by talking about the tax benefits of hiring your family in the first place, because if you do not understand this, then the family management company becomes completely irrelevant. So first of all, why would anyone want to hire their family members to work in their business? Well, on the highest level, it allows you to take advantage of income shifting. You see, your taxes are based on your business income. And when you pay your family members from your business, it is a tax deduction for your business, which then removes that portion of income from your tax return. You are taking money that would otherwise be taxed at your higher tax bracket and shifting that income to family members who may be in lower tax brackets. For instance, if you are now in a 30% tax bracket and you have a family member in the 12% tax bracket, you would save the difference of 18% in taxes on the amount that you pay them. And in some cases, especially when you hire children, it can result in a 0% or $0 in taxes owed on the income they receive, which I will talk about in a second here. But first, the overall concept here is that we are taking some income off of your tax return, which lowers your taxes, and we are placing the income on a family member's tax return who would owe no taxes or very little in comparison to you. Okay, so let's talk about how the family member can actually pay $0 in income taxes on the amount that you pay them. So to accomplish this, you must first be mindful of the standard deduction, and this changes every single year, so you need to be aware of this. For 2024, the standard deduction amount is $14,600 for single taxpayers, which every taxpayer can take advantage of. This means that if your family member reports less than this amount in income, they would pay zero income taxes as a result when they file their own tax return. And you can do this for each family member you support, since they each can file their own return. So let's say you have 5 kids and you pay each of them $14,600 in income. Well, then you could write off the entire $73,000 from your business income, and each kid would owe $0 in taxes when they file their own tax return, thanks to the standard deduction. So this concept works great for people who have children, retired parents, or other family members who earn little to no income. But keep in mind that this can still be very effective even if it results in the family members paying some level of taxes. For example, if your family member makes less than $47,000 per year as a single taxpayer, their maximum tax rate would just be 12%. That's still a very low amount of tax for them to pay, especially if you are in a 30 to 37% tax bracket. Just think about it. If you had to choose between a 37% tax and a 12% tax, which would you choose? I think you know the obvious answer here. And I have some clients who will even pay their family members' share of taxes on their return just to save the difference overall on their end. The bottom line is that if you are in a situation where number one, you own a business, number two, you support your family members financially, and number three, you are in a much higher tax bracket than that family member, then paying them from your business can save you a significant amount of money in taxes, period. With that said, let's talk about where the family management company becomes beneficial for you. Okay, so first of all, by default, you do not have to set up a family management company to hire your family members. However, doing so can save you a little bit more money in taxes, so let's talk about why that is the case. So first of all, what is a family management company? It is simply a separate entity that seeks to employ members of your family, allowing you to pay less taxes. Now, this is usually set up as an LLC, sole proprietorship, or partnership in some cases, which is key here. Because when you operate as one of these entities, the IRS says that payments to a child under the age of 18 are not subject to Social Security and Medicare taxes, which is a huge tax benefit here. But this poses an issue because it is usually more beneficial for the owner of the business to use an S corporation or C corporation once their business income reaches a certain level. Otherwise, they would pay a huge amount of self-employment tax, which, by the way, is an extra 15.3% tax on all of your business income up to a certain limit. So on one hand, using a corporation reduces your self-employment tax as the business owner. But on the other hand, using an LLC eliminates Social Security and Medicare tax for your children when you hire them in your business. And this is where setting up a separate family management LLC becomes beneficial. It gives you the best of both worlds, allowing you to maximize the tax benefits associated with your corporation and those benefits associated with an LLC taxed as a sole proprietorship or partnership. Now, to get this to work, you would keep your corporation and set up a separate LLC to act as your family management company. And then your management company would need to provide a service to your corporation. For example, it could act as the corporation's back office by handling all administrative functions, such as processing payroll for the company or paying the corporation's vendors. Just think about the word management company. And in exchange, your corporation would pay the management company a fee to provide this service to you. Now, by paying this fee, you are shifting income from the corporation over to your family management LLC. And once that income is in your management LLC, you can start maximizing your tax deductions in that entity to erase as much of that income as possible. And this is where you would hire your children and pay them. And since you are doing so from your family LLC and not the corporation, they would pay no Social Security and Medicare taxes on the amounts paid to them. But that is just one benefit here. I have seen people also add their spouse as a partner to the family management company, allowing that spouse to set up their own retirement plans, take their own home office deduction, and take several other tax deductions through this separate entity, like vehicles, meals, and travel. And depending on your situation, you may also bring your parents, siblings, or other family members into the business, whether that be through adding them as an owner of the LLC, an employee of the LLC, or contractor that provides services to the LLC. For example, I had one client who hired his mother as a business advisor for his business as a way to shift income to her while reducing his own tax bill. There are endless, literally endless possibilities of ways you can shift income from your business over to your family members. Now, you may be wondering, is this legal? Well, the short answer is yes, but everything has to be 100% legitimate. So if your family LLC is providing services to your corporation, then there should be a legal agreement in place outlining the services to be provided and the fee structure. And when it comes to hiring your family members in any company, really, they must do legitimate work for your business, and the amount you pay them must be reasonable for the type of work they are performing. Look, it is not illegal to hire an employee to do a job for your business, whether they are related to you or not. It is not illegal to hire a consultant or board member to advise you on your business, even if it is your parent. And it is not illegal to add a business partner to your business, such as your spouse, and so on. But what is illegal is creating false records or lying, like creating a W-2 for a family member that did no work for your business at all. If the IRS audits you and you do not have record of the work or the job contract that reflects the scope of what you hired that person for, then you may find yourself in serious trouble. Now, you can avoid all of these issues by simply putting a plan in place that helps you legally take advantage of this strategy and several others, which is why it is important for you to have a good tax CPA in place. And if you need one, just go to mycpacoach.com to apply to become an exclusive client of ours today. And as always, thank you for watching.